Good morning. Today we are going to talk about the measurement of income, prices, and unemployment. Mainly in this part, we are going to describe the circular flow model or the interaction between the various sectors in the economy. But why we care about income? Mainly we do care about income because two main reasons. Number one, the key to understand the changes in unemployment is the changes in actual real GDP. And as you know, that one of the main objectives of any country is to decrease unemployment rate. Number two, the growth rate of standards of living is measured by productivity, which requires understanding of real GDP. Okay, let's start with the circular flow model. For simplicity, we are going to start with a two-sector economy, and then we are going to add one more sector and then one more sector. As you know that the economy consists of four main sectors: household and firms, government, and rest of the world. So for simplicity, we are going to start with the simplest form, which is a two-sector economy. Circular flow of income and expenditure model is simple representation of the macroeconomy. For simplicity, we are going to assume that there is no savings and no government. And as we said, this is the simplest form. Of course, there is no external sector, by the way. So this means that we are going to study circular flow in case of two-sector economy, three sectors economy, and finally four sectors economy. Let's start with number one, which is a two-sector economy. The two main sectors under consideration are households and firms. Household must work in order to earn income to pay for their consumption, while firms sell goods and services paid by households. In this case, income equal expenditure, as there is no savings, there is no government, and there is no rest of the world. So if we assume that households are going to provide their services to businessmen and they are going to get income in return, this is income. They are going to provide labor services. Say, for example, this income, which is Y, equals 100,000. Households are going to use their money income to buy products from firms. So they are going to get products from firms and pay the price of this product, which is known as consumption expenditure. Which is equivalent to the money income received, as there is no savings, there is no government, and there is no rest of the world, which is equivalent to 100,000. So in this case, Y equals C. So income, which is Y, is equivalent to labor services, which is equivalent to consumption expenditure, which is equivalent to the products, the value of the products. Each of the four elements in the figure, income, labor, services, product, consumption, expenditure, are flow in a flow magnitude. Flow means addition or a change. So this means value of output produced by firms equals value of expenditure by participants in the economy. Value of output produced is equivalent to value of expenditure. At the same time, this means value of output produced by firms equal total income generated in the economy. Once again, there is no government expenditure, there is no savings, there is no external sector. What's GDP and what is not included or counted as GDP? GDP is defined as the market value of all final goods and services that are currently produced and sold, not but not resold. Through the market during the current time period. So the GDP of a country is often referred to as the country's output and or income. So this means that GDP is an indicator or a measurement of income and output at the same time. There are three major rules for including items in the final good. Let's talk about the main elements in this definition. Number one, currently produced. This is what's in and what's out, and this is the category. Number one, currently produced. With respect to currently produced, all goods and services produced are counted. But what's out? Sales of used goods or used assets. This is not going to be currently produced. Sales of financial assets. Transfer payments. What's meant by transfer payments? Transfer payments, which means gifts from one person to another, gifts from the government to persons, social security, medical care, unemployment benefits, all of them are transfer payments. Capital gains. Capital gains means accruing a gain or additional profit from an increase in the price of an asset, a change in the value of the asset itself. It's not an actual increase in production. So in this case, it's not going to be counted. Number two, sold on the market. Sold in the market means market production. So all market production is gonna be counted as in GDP. So sold in the market means goods must be sold in the market and valued at their market prices. What about personal time spent in activities that are not going to be sold in the market? Say for example, self-consumption. So this is gonna be excluded. Home production. It's not gonna be counted. Environmental pollution. It's not going to be counted. Illegal activities. Both are not going to be counted. So this is with respect to sold on the market. Number 3, not resold. Not resold means it's final goods and services. So this means that intermediate goods and services are going to be excluded or not going to be counted. So when we are going to talk about not resold in the market, we have to differentiate between intermediate goods and final goods. Final goods are sold for the final consumer, while intermediate goods is resold by its purchaser either in its present form or in an altered form. So if you would like to count the final form, we have to deduct the intermediate good. So we have to calculate the value added. Value added means firm's output minus intermediate good, the value of intermediate good. So now we have to differentiate between domestic and national. GDP, which is gross domestic product. What's domestic in GDP? And what's the main difference between domestic GDP and national GDP? GDP includes all final goods and services produced within the country, regardless of whether they are sold in the country or exported. Imported goods are excluded. So it is produced within the country. This means that imported goods are going to be excluded. What about gross national product? Or GNP? GNP produced by the country's residents, whether they are located within the by the country's citizens, whether they are located within the country or abroad. So this means that GNP equals GDP plus factor payments from the rest of the world minus factor payment to the rest of the world. So this means if an Egyptian worker working in United States, so income received by this worker is going to be added to the country's GDP, and if an Chinese worker work in Egypt, his income is going to be deducted from GDP in order to find GNP. What is the growth in GDP? Gross. What's meant by gross? Gross means includes depreciation or part of the fixed capital stock used up due to wear and tear and so on. Or in other words, this means it includes consumption of fixed assets. So GDP includes depreciation, or in other words, consumption of fixed assets, of fixed capital. So net domestic product, if you would like to find net instead of gross, it's gonna be calculated as gross domestic product minus depreciation or consumption of fixed assets. Now we would like to add savings or one more sector to the economy. So we have to understand the main components of GDP. GDP is calculated as consumption plus investment plus government expenditure plus X minus M. This is the general definition. And we can write it in another way as investment plus G plus X minus M. And actually C is going to be divided into consumption by the private sector and consumption by government. So we can write it as C private sector plus CG. And in this case, we are going to remove G. And also we can do the same with respect to I. We can write it as I private sector plus IG. If you are going to add IG and CG, both of them are going to be, government expenditure. Okay, so we can write the equation in different forms as GDP equals C plus I plus G plus X minus M, or CP plus I plus CG plus IB plus IG plus X minus M. Okay. Anyway, we are concerned with understanding each one of them in details. C, I, G, X minus M, and so on. Let's start with investment. What are the different types of investment? Investment means final goods that business keeps from themselves. They are called private investment or capital formation. So it's equivalent to the word investment is capital formation. Actually, investments or capital formation add to the stock of income yielding assets. There are two different types of private investment or capital formation. In this case, we are going to talk about private investment mainly. It's not going to include G. Later on, we are going to explain G in terms of government investment and government consumption. But for now, I stands for investment by the private sector. Okay. So there are two main different types of investments by the private sector. They are inventory investment, which is the change in the stock of raw material, parts, and finished products. These products are not sold in the market immediately. Okay, so inventory is a change in stock of raw material, parts. Parts means intermediate goods. Finished products held by businesses. Any good that unsold automatically are counted as part of unplanned inventory. The second type of capital formation or investment is known as fixed investment. Fixed investment includes all final goods purchased by businesses not intended for resale. Say, for example, houses are not going to be counted as fixed investments. So once again, houses are final goods purchased by household instead of businessmen, but with respect to household, in this case, they are going to be like an investment for them. So they are counted as fixed assets. So, for example, houses, from the point of view of their purchasers, are counted as fixed investments. So in order to invest, we have to save. Now we are going to relax one of the assumptions that savings equals zero, and we are going to assume that there is saving in this case. So we would like to study the relationship between investment and savings. So personal savings is the part of personal income that is not consumed or paid out in taxes. So we can write it as savings equals Y minus T, which is disposable income, minus consumption. Or we can write it as YZ minus C, where T is net taxes Later on, we are going to explain what's meant by net taxes. Funds from savings are channeled to firms in two basic ways. Number one, household buy bond and stock issued by firms. Number two, deposit savings in banks. Firms use the money channeled from savings to buy investment goods. Savings is considered as a leakage, while investment is considered as injection. So we have to add two new concepts. They are leakages and injection. Leakage means money withdrawn from the circulation, from the circular flow model. They are not going to be added to the circular flow model. While injection means addition or money that will be added to the circular flow model. So let's return back to our example that we have household and firms. In this case, there is savings or capital market or financial market. Okay, this is capital market. Households are going to provide their services to firms and get income in return. Which is 100,000 as we said before. But in this case, households are going to distribute their money income between consumption expenditure and savings. So they are going to consume so consumption expenditure which is equivalent to 80,000, and the rest of money income will be leakage or personal savings, which is equivalent to 20,000. If firms are going to get this money from capital market, this is going to be an injection, which is equivalent to 20,000. This is going to be investment expenditure injection. So once again, households are going to provide their services to firms and get income in return. They are going to distribute their money income between consumption and savings. So they are going to buy goods and services from firms, and this is known as consumption expenditure. They are going to save their extra money in the capital market through borrowing, through depositing money in banks or through buying bonds and stocks. And this is considered to be leakage. Firms are going to use money income from consumption and they can borrow money from the capital market. And this is known as investment expenditure. This money is equivalent to savings. This is injection. In our example, this is equivalent to savings, but maybe later on it can be different from savings. For now, we have talked about two main sectors. Next week, we are going to add more sectors to the circular flow model. Thank you and see you next week.